Oh, a very, very good evening to all. And I stress on the word good evening because I think if a certain day doesn't look good, like what we were discussing, I'm sure there's another bright morning on the other side of the day. So I insist to call it a good evening and welcome all panelists, as well as our chair, Mr. B.K. Sabharwal, and our co-chair, Mr. Rachit Gupta, on this virtual session on investment options and strategies for MSMEs. I'd like to once again thank Mr. Inderpreet Singh Jolly, National Head for Wealth Partners for ICICI Securities Limited. My special welcome to Mr. Ramesh Varketkar, Head Commodities and Currencies, ICICI Securities Limited, Mr. Ajay Bagga, Market Expert, much sought after, and of course, Mr. Narendra Wadhwa, President CPAI. Globally, many nations, particularly developed countries, are focusing on a number of strategies for MSME development. In India, innovation, business incubation, cluster approach, skill development, public-private partnership, social entrepreneurship, and export promotion are prominent among them. A new scheme, MSME Scheme 2020, provides loans up to 10 lakhs to non-corporates and non-farm small or micro enterprises. These loans are classified as Mudra, the Micro Units Development and Refinance Agency Limited. Mudra loans under PMMY. Mudra is a non-banking financial company, NBFC, which supports the development of MSMEs. We will be discussing this in further detail with our esteemed panelists this evening. So as we move ahead, may I now call upon Mr. B.K. Sabharwal, Chair, Capital and Commodity Market Committee of PhD Chamber of Commerce and Industry, to formally welcome and initiate the webinar. Over to you, Sabharwal ji.
Welcome to all the panelists, especially Mr. Ajay Bagga ji from a hectic day. He is still here with us. My apologies that he is a person who keeps on speaking to more than 500 people or 1,000 people physically, but to a very small gathering on the webinar he has to speak. I also welcome my very dear colleague in CPAI, Mr. Ramesh, Mr. Jolly, and of course, Mr. Very lively, the National President of the CPAI, Mr. Narendra Wadhwa. I straight away request Mr. Wadhwa to give his presidential address, a man of the market. Mr. Wadhwa basically is a chartered accountant and a law graduate, a stockbroker from last 20 years. His total family is into the financial markets. Even his uncles and all that are very reputed. And his brother-in-law, they are one of the best chartered accountants of the country. And today, he is a leading broker with the name SKI. He had been the chairman of the Association of National Exchanges Members of India, ANME. Now the president of the Commodity Participant Association of India. He is chair of the Capital Market and Commodity Market Committee of ASSOCHAM and the managing committee member of FICCI also. Over to you, Mr. Wadhwa, for your presidential address.
Thank you, Sabharwal ji.
For kick-starting the event.
Thank you, Sabharwal ji. Good afternoon, everyone. Ajay Bagga ji, Inderjeet ji, Ramesh ji, and Mr. Vivek Sehgal from PhD.
Mr. Wadhwa?
Yeah. Can you hear me? Can you hear me? Okay.
Yes, sir.
So good afternoon, everyone. Ajay Bagaji, Inderjeet ji, Ramesh ji, and Vivek Saigal ji from PhD. Very warm welcome to you all, my dear friends and colleagues in PhD and our members. First of all, I thank PhD for associating with CPI in various programs related to markets. On behalf of CPI and PhD, it's a pleasure for me to give opening remarks on the MSME and opportunities for investments. So we are on a day when markets has taken a dip majorly, the biggest hit in last 2 years. NSE was down 850 points and BSE was down 2000 points. And especially discussing the market and investment is a challenging task, but it's an opportunity also for the various investors. See, I am from CPI, as just Sabharwalji has just mentioned, and from the market. So for commodities market, I feel the markets provide great opportunity for hedging for commodity derivative markets. Is a platform for price discovery as well as price hedging. So SMEs should definitely, in an inflationary environment when the input cost is going up and there is an uncertainty in the market, should try to use these platforms for both the objective of price discovery as well as price hedging. And as I am also a merchant banker in my company, I would again suggest that there are potent platforms in the exchange for SMEs for raising their capital. All along, we have been depending on the bank finances, but the market, capital market is opening up and there is enough liquidity and enough investor to bet with the MSMEs also. They should try MSME platform of BSE as well as NSE also. And as we know, MSME is a backbone of our country, employing more than 80% of the workforce. So government has also very serious to promote MSME sector. Although we are transforming from unorganized to a formal sector, where there will be very many challenges for MSME. But I know these chambers like PhD and ASSOCHAM or other chambers will conduct programs like these to educate our MSME friends. And I'll not take much time. We have eminent speakers today. Ajay Baga is a good friend and market veteran. So, and Mr. Inderjeet Singh. So they'll be discussing about the investment opportunities in the market. Thank you very much once again. Thank you. Over to you, Sabharwalji.
Today, we have 3 panelists, and Vivekji, will you like to continue or should I?
No, please continue, sir. Please continue.
Mr. Inderjeet Singh Jolly ji will be talking about the wealth, about the commodity and currency. It will be Ramesh ji, and overall market and about the Indian economy, we have the expert, Mr. Ajay Bagga ji. Ajay ji, initially we have thought that we'll call Mr. Jolly first and then Mr. Ramesh and then you. But if you are in a hurry to go, we can even change the pattern.
No, sir. Please continue with your pattern. I'll wait.
Actually,
no problem.
First of all, I will request Mr. Inderjeet Singh Jolly ji, who is really looks like a jolly person when he was talking before, even 4 o'clock on the various subjects. So, not even giving straight away much introduction as we have very less number of attendees today. Over to you, Mr. Inderjeet ji, to talk about the wealth part and about the capital market part.
Yeah, thank you, Mr. Sabharwal, Mr. VK Gupta, Mr. Sehgal, and Shivani for giving an opportunity. And very good evening to Mr. Wadhwa, Mr. Bagga, and Mr. Narendra, my co-speakers. I have a small presentation to share, which I will briefly run, but the subject which I am going to speak is going to be more on the fundamental and the core side of managing our money. because we have industry experts to talk on the market scenario and the market view. I will stick to the more fundamentals of investing and more fundamentals of allocating your assets across various type of pattern, which will I think build in more solidarity on a portfolio. So I'll just share a small presentation. Is this visible?
Yes, sir. Yes, sir.
Thank you. So my agenda of discussion is I'll talk a little bit about ICICI Securities, the organization where we work with. Then, of course, what is our approach towards various needs on the financial side, and of course, how do we approach a portfolio in terms of protection, asset allocation, and then how do we execute it? I think at an individual level or an institution level, if we can manage some of these basics in place, it can definitely build a very long-term healthy portfolio, then also probably hedge against some of the uncertainties and some of the other scenarios like we have been observing today. So before I start, I just want to give a very, very brief thought, a personal, thought on the subject that we all feel that managing money now with the growth of digital, revolution, so much of disruption happening, so many players in the market, so much of information available, we always feel that managing money has become very simple now. It's easy because so much of information, and we have so much of, access through various channels. But I also feel that because of disruption in the market, because of so much, new currencies getting added, because of so many new formats of investment coming in, because of so much, the world has become a far more smaller place. So because of so much of globalization and digitalization, I think it is equally complex also. So money is not only in terms of simple to manage or, is easy to manage, but parallelly it's also complex. So we need to understand the balance here. We need to understand that what makes managing money simpler and what are the complexities which we need to probably protect ourselves from. And hence we then we get into the subject where we analyze the market to ensure that, our short-term investments are in place, and parallelly we have a right asset allocation strategy to ensure that our portfolio is reviewed on a right term, and on a longer period, it is far more stable and better. And of course, last is that what kind of wealth manager we choose or what kind of strategy, what kind of platform process they follow is also very critical to basically give a complete 360-degree, view on the overall management of. So it's not easy, as it seems. It's a process, and I will try to cover all three parts of this, of this requirement. So little bit on ICICI Securities. Yeah, we are a part of ICICI Group. We manage more than 5 trillion. Now I talk about 3.8, but the ICICI Securities manage over, 6 to 7 million clients and over 5 trillion assets. And we are part of the entire ICICI Group, which I think is a fairly accomplished financial institution in the country. The parentage. So what are the 4 important parts of our organization is the parentage, where we have, of course, the ICICI Group ecosystem, the people where we invest quite deeply into our research, our people, our relationship managers, the private bankers. Proposition, we have 50 plus products and services, and we are open architecture. So we want to be neutral to any specific product or scheme. We want to be neutral towards the investors. And of course, the platform. So ICICI Direct is one of the leading platforms. And I think we are in online business or in digital business since 2000. So I think we have been one of the early starters on this space. So these are the 4 important pillars of our business. The core of the business divided in 2 parts. I'm keeping the corporate banking and the corporate side aside. On the individual side, since the subject is more around individual or promoter-based, investment. So we have 2 categories. One is the retail, and another is the HNI. We call it select and private wealth management. And I'll talk more a little bit on private wealth management, where we are assisted by, about 400 private bankers, a family office and investment team, and we have an equity advisor team to support an overall requirement of our clients. Then some of the critical values which we follow is transparency, expertise, trust, exclusivity, empathy, and legacy. So we definitely follow these values to the optimum level and ensure that all these values are reflected in the way we are managing our clients, especially in the HNI and family office side of business. These are our pillars. So our product suite is divided into these parts. The reason I'm covering the product suite is because somewhere or the other, we all are part of this kind of a product suite only. And how to choose the right product is a part of a process, which I'll come to. But Yeah, our product basket is divided into 6 parts: equity broking, where we have within domestic as well as international, equity trading and broking. Investments, of course, investment, goes into the non-broking side of business as well, which is mutual funds, portfolio management, ETFs, bonds, fixed deposits, gold, alternates. Solutions will go into retirement, NRI, goal-based. Loans, yeah, we have a very, very aggressive and a very, very comprehensive assets and loans distribution network, where we are again an open architecture with about 6 to 7 banks and 4 NBFCs. And again, protection, and then value-added services like credit card. So, will and estate planning, tax advisory, loyalty added services. So this basically covers the entire cycle under a single platform for the client. What is our approach towards, protection, retirement solutions, and portfolio construction? This is more theoretical. I am trying to cover is because sometimes, as investors, we miss the theory, in the process of investing, and we go with more of the practical and, information-based approach, which is, so I wanted to cover a little bit of theory, so just bear with me. So 3 important needs is protection, retirement solutions, and of course, the entire investment process. I'll quickly spend a couple of slides on the protection retirement solution. The intent here is not to promote any insurance product, but definitely protection is an important part of all of us, whether it is individual or whether it is covering against a liability or whether it is protecting a key man in the company. So obviously term insurance is something which we all know about, or we all should look into. It's a very critical part of protection. And leaving term insurance, I'm sure we all have experiences with organizations like LIC and some of the top private companies, where we get into various needs and services which cover the overall life cycle in the insurance side. Then health insurance is another part which is critical part of protection, where of course we cover critical illnesses, and COVID has only taught us that it is more important to have proper medical covers, covering the various phases and uncertainties, which can otherwise put your entire investment planning into a lot of stress. And then the types of medical insurance, I'm sure we all are aware about. And then retirement solution. While retirement solution overlaps into protection also, but I wanted to bring the NPS strategy to everyone's notice, because I think that here the objective is restricted to investments only. And there are some good pension fund managers, and we'll see more pension fund managers coming in. And I think a long-term strategy or a long-term saving plan is quite an important tool for everybody. We should not look at it only as a tax saving tool. I think it's a very, very critical tool to allocate some money towards a long-term saving, whether we are into business or we are into a job. I think saving in a long-term strategy always helps. I'll spend some time on the structured investment process which we follow, because I think investment is a very, very broad term. It can be as much as a day trading to as much as a 25-year-old plan. It can be as short term or as long term as we want. But how to go about the investment strategy is a process which we follow. So as an organization, as a private wealth player, what we do is that we profile the customer. Before profiling, I don't think it is prudent to give any advice or any suggestion to the customer, because we need to know the risk appetite, preferences, needs, and goals of a client. Then we do the asset allocation, where we personalize the portfolio and probably allocate the asset into the various asset classes depending on the profiling. And only post asset allocation, we get into the best performing or good quality schemes which we evaluate centrally. And then most critical part is active engagement and recommendation. So the review of the entire process on a timely basis is extremely important. If we don't get into reviewing our portfolios with the right people, I think it's job half done. So a little bit on profiling. What we do is that we look at the risk profile, we look at the financial risk, which is the risk capability and the risk attitude of the customer. It's not just the risk capacity, but also the attitude, because sometimes the wrong attitude can definitely, make us pay dearly, and vice versa. So it's ability to take risk and willingness to take risk. We analyze that, and we also look at the goals as the other parameter, where there definitely the goals change with age. So below 35, 35 to 50, and 50 plus, these are the 3 major life cycle stages which we all go through, and our goals definitely are different in each of the stages, or at least most of us, have different goals. So obviously the profiling has to be according to that. Then after profiling, we do the asset class and asset allocation. So there are three major asset classes, under which most of the investment schemes fall into. One is equity, other is debt, and third is alternates. Depending on the risk profile of the customer, obviously we will, give, and of course the liquidity requirement of the client, we will allocate money into equity, debt, and alternate asset classes. And when we do an asset allocation, we look at investment horizon, risk tolerance, and goals as a whole. And we then divide that into two parts. One is a strategic allocation. So somebody, who wants to plan a long-term portfolio. So obviously there's a strategic allocation basis, these three, parameters, which we carry for over a period of time and we keep reviewing. But however, like in current situation where markets, definitely last 3 cycles, the markets have been correcting, we may get some more correction, and there may be a lot of tactical calls available, the strategic calls available also, which can also convert into opportunities for us. So that we call as tactical asset allocation. So a combination of strategic and tactical asset allocation is very important to ensure that our portfolios are poised to beat the benchmark or give some alpha over the benchmark, because I think that's what as a customer we expect from every wealth manager. So that is how we plan. And most of the times, if the planning is correct, then obviously the results are also far more better than what they have, they can be. Indicative portfolios, then we divide into, where the client is risk averse or the client is conservative or it's balanced, growth, aggressive, and accordingly we allocate. So this process puts some maths and science into the entire process. Portfolio construction, again, as I said, to sum it up, we do it on the basis of risk appetite, objectives, goals, and we divide into the various life stages of 35 to 50 and 50 plus. And accordingly, we offer them product solutions and we also look at the preference of the client. So this process basically takes us into a far better situation to then get into the scheme level. Couple of philosophies which we always advocate, and I think we all should advocate to our client, our family and next generation, and also that, of course, the importance of starting early is very, very important. The earlier you start, the lesser money you need to allocate to reach your goals. Or the earlier you start, the higher, overachievement can be there in terms of planning our goals. I think we have seen enough history and, around this. Same way, investing in a systematic basis always helps, not just SIP, but I think systematic investment is a tried and tested theory across all types of investors. And I think it is safe to say that this kind of strategy works for everybody. Core can be definitely around this kind of strategy, and while we can, take tactical calls and do so. So these are the two major philosophies which cut across the entire planning process, which I think as investors, we must definitely follow. About execution. Yeah. So now once we are ready with the identification of the goals and asset allocation and the planning process, I think the next and the final stage comes in the execution and the monitoring process. So how do we execute? We have ICICI Direct platform to execute, most of these transactions, whether we do it online or offline. So we do the planning where we have research reports, educational content, execution, transactions across investment and, across all asset classes and other products. Monitoring, we have enough portfolio statements, stack statements, consolidated reports available on the platform for our clients to monitor the progress. And then again, we have enough analytics to track and rebalance the portfolio, because all these 4 things go hand in hand and are quite important. So as an iDirect platform, we have the entire execution happening digitally for us. Research, yeah, we have fundamental, technical, derivative, commodities, currencies, and mutual fund research. So we cover more or less all parts of the investment, cycle. And of course, we get into all types of detailed reports. We have come up with managed solutions also, where we make curated baskets for clients. And I think they, without getting into the stock level, stock specific research, they can get into the curated baskets, or they can get into the PMS kind of portfolios, which we have made, where investors can get into as low as 5 lakh rupees and can go as high as any amount into these baskets. So we have created a lot of managed solutions also for our clients who do not want to get into analysis or who do not have the capability to analyze the investment products in detail. So we do it at the back end, and we make it much more easier for the clients to invest. Product selection framework, we follow a very, very robust product selection framework and risk management. Starting from, we have a monthly strategy meet where the various committee meets and they discuss on the markets and the various opportunities available. Then we have macro views where we look at asset classes, sectoral outlooks, asset allocation, investment framework. We have a quantitative review where we look at fund manager, fund house track records. We have a qualitative review where we see portfolio manager interactions, fund house and portfolio due diligence, screening, product selection, and then product universe. So this is a proper framework which we ensure that we do at a back end before we recommend anything or before we make any product strategy for our clients. This basically mitigates risks at various levels for our investors, and it can also ensure and give us some mitigation in current scenarios or scenarios like which we see where things are beyond our control. And on the ICICI Direct side, we are divided into two parts. One is pure equity and other is investment products. So in equity, we have developed various facilities, various strategies, which are available for the investors who want to actively trade into equity, futures, and options. And on the investment side, we have a proper robust model for mutual funds, fixed deposit, bond, PMS, alternates, golds. And then on the digital side, we have created inbuilt portfolios in the system, which I think can navigate us through various market cycles, give us exposure to various types of different stocks, give us exposure to various types of asset classes, which makes it much more easier and which are researched at the back end from our side. Then we have mobile apps. Now, digital revolution, as I said, is a very, very big word here. Digitization is the way forward. Last 2 years has only propelled it more. So having strong mobile interface, mobile application, a very good UX or a user experience is very, very important. So we are working a lot on that. And we have created a couple of apps, one which deals into the non-equity side of the investments and other which deals into the equity side of investments, because I think 70% of the transaction or the internet transactions have moved into mobiles. Equity interface continues to improve, and thanks to the competition which has come now, I think the entire broking space has got so many players, and I think digital players are coming and disrupting the market every day. I think it's pushing even the big players to improvise and give a better deal to the client, better experience. And global investments, yeah, we are now having a global investment platform where we can invest in more than 7 countries, right from India, right from the ICICI Direct platform. And we can invest into direct equities of these countries through an international broker, which we have tied up. I think this has really, really opened a huge universe of opportunities for our investors. And I think this is the way forward. The world is becoming a smaller place. So it's important to empower the investors with more and more opportunities available globally. Premium portfolios, I just said that we curate strategies for direct equity, 15 to 20 stocks, consolidated strategy, and we empower the client to invest with as low as 5 lakh rupees. Otherwise, such strategies are available at 50 lakh rupees of invest. So again, this is an example of how we are empowering the investors, and the best of the best fund managers from the market are coming and participating with their stock portfolios on the ICICI Direct platform. I think this is what we call open architecture, and this is what we call unbiased opportunity for all the clients. And we are trying to build further on that, because we feel that concepts like managed solutions, robo-advisory are only going to become more prominent in the next 5 to 10 years, because investors are becoming more savvy, more digitized, and more intelligent on, as we go forward. So we have empowered them with this kind of strategy as well. We have direct plans for mutual funds. For all the investors who want to invest directly in mutual funds, we have that kind of plan and platform also for them. But of course, that is restricted to more on the HNI side of business currently. And then we have our own in-house PMS strategy. While we also have tie-ups with all the AMCs to offer portfolio management service, we have our own in-house portfolio management services also. On the asset side, as I said, we have more than 12 loans, because I think as the economy, we are growing, lending is becoming more and more prominent, whether it is on the mortgage side of business or whether it is on the mid markets or small markets or large corporate side of funding, or whether it is getting into the real estate side of business or personal side of business. I think lending is becoming more and more prominent, in our whole recovery process. And I think as a group, we feel that this is a big opportunity for the borrowers as well as lenders. And with low interest rates, I think this is again a sign of customer empowerment. We are open architecture here as well. And again, we have a very aggressive portfolio, which I said, track the portfolio. We have all the statements, reports available in the portal to track the statements. And then we have, again, yeah, as a private wealth company, we have been bestowed with quite a few, recognition and awards, for our work. And we continue to grow leaps and bounds on this side of business. So this was a short presentation from my side. Thanks a lot for this opportunity.
Thanks a lot, Mr. Jolly. In a very short span, you actually total ICICI Direct.com, what are all you are doing and what are all the facilities available for the people. You have narrated it. And now I will request my dear colleague, Mr. Ramesh, though he is with ICICI, but a long stint he was with Karvi also, but he left Karvi before the Karvi problem actually came. And he is a man known of the commodity and currency. So that commodity and currency, and if we can talk a little bit about the crypto also, so that will be really good. Over to you, Mr. Ramesh.
Is my presentation visible? Am I audible?
Yes, yes.
Yeah, Ramesh.
Okay, thank you. My colleague Jolly briefed about all the products at ICICI. I'll focus my presentation on currencies and commodities. So before I start, let me take this opportunity to appreciate all the great work done by Sabharwalji, Vadvaji, and also Ashokji is not here. I call them Trinity at CPII, and they've been doing great work, a lot of work on the commodities market. And let me tell you, all the three of you are my mentors with respect to commodities business. And I've always been following all the three of you. Coming to currency derivatives, as Vadvaji also mentioned, SMEs contribute to almost 45% of industrial production in India. 40% of exports in India is done by SME, right? But when it comes to the foreign exchange, I don't think that they get a great deal whenever they are converting their foreign exchange with any of the banks. Let me tell you, before I move forward, why about me and why I do what I do. I've worked with bank for 7 years, which is a private sector bank and MNC bank, worked with exchange, and now in broking industry for last 7 years. But in my stint at 6.5 years with the banks, which is private sector and MNC banks, especially for SME, I found that the spreads that the bank used to charge was pretty high. And as a business guy or RM, I used to see it used to be 60, 70, 80 paise also. There's one of the studies which was done by one of the consultant, which said there's a huge revenues which the bank makes out of the currency exchange from all these SMEs and MSMEs. So when I was working with the bank, when I found out, and it was way back in 2008, 2009 when exchange got launched, I thought this is a great business and I can also have a peaceful sleep because these are all transparent markets. So that's how I moved into currency derivatives market. I'll just run through the presentation on currencies. Currencies are the second largest market after interest rate across the globe. Yeah, as I said, in India, it was introduced in 2008. NSE started first. First, it was futures, which was launched, and gradually in 2010, currency options was launched. The volumes, I remember in 2009, when I was with the exchange, we did some 100 crore for the first time and we cut a cake in the evening. And as we speak now, I was just seeing the NSE website, the volume today, till now, even the markets are not yet closed, they'll close at 5 o'clock, is close to 2.5 lakh crore. I'm talking about 12 years back, 13 years back, we cut a cake for 100 crore turnover at exchange. And 13 years down the lane, today, it's 2.5 lakh crore is what is the volume which is happening. So that shows the participation which is there in this market. It's across all the people. It's all corporates, SMEs, individual traders, institutions, FIIs, all who have been participating in these markets. And we see a great trend on the options side. Options side is almost 75% of the market, and it's been growing phenomenally. With all my experience, I just had this slide, which I thought I'd just differentiate between what is the difference How the exchange markets are better than OTC markets. At exchange, the participants are not only just corporates, but all resident Indians, FPIs, who are all permitted to trade, participate here. Whereas in OTC market, one needs to have an underlying or a past performance certificate. So that means it can be any of your companies like yours, which is a SME or a MSME who's into import and export. Only they can go and hedge at the OTC market. Whereas at exchange market, there are many participants who can participate. So obviously the liquidity and volume is pretty high. You look at the bid ask at exchange, it's very, very tight. Just quarter paisa is what is the difference. But when you go to the bank, the spread become as wide as 2 paisa, 3 paisa, 4 paisa also. A high transparency of pricing at exchange. From Kashmir to Kanyakumari or from east to west, everybody can just log into one platform, see one transparent price. Let it be a large corporate like Reliance Industries or any student who's traveling abroad. Right? And when it comes to the lot size, here it's very small. It's just $1,000 is one lot. So a company having a smaller exposure can just go and do the multiples of 1,000 and hedge their exposure. It's very easy to trade, very easy to transact. One can do it on website, one can do it on a ICICI mobile apps, so on and so forth. Right? And the most important part after pandemic in last 2 years, the OTC market timings has been shrunk. Earlier it used to be from 10 to 2, but now got extended. Now the timings is 10 o'clock to 3:30 p.m. Right? But when it comes to exchange market, it's from 9 a.m. in the morning to 5 p.m. in the evening, Monday to Friday. So you have a larger time, especially in case you know that today something big is going to happen. As we speak, today's volatility has been almost 1 rupee 10 paisa, 1 rupee 20 paisa. So in case you know that there's going to be volatility, you need not wait till 10 o'clock till the bank opens to hedge your position. You can straight go log on to a broker's site like ICICI Direct and hedge your positions at 9 a.m. itself. So these are the few of the benefits of hedging your exposure on an exchange platform compared to a OTC platform. As I mentioned, especially for corporates like you, risk management is very, very important. I keep interacting with few of the importers, and last few weeks I've been interacting with few importers. They said, Ramesh, अभी हमको hedge करना नहीं है. हमें लगता है ये 7350 जाएगा. LIC का IPO आएगा. Lot of inflows is going to come. Rupee will appreciate. We'll only hedge at 73.5, 73 levels. So you see where we are today, 7550 plus. So any of these risks will always be there. So the best part for a SME or a MSME who have exposure is to hedge. You are in business of doing your business, which is your manufacturing or any of the other services, not in business of making money on the foreign exchange fluctuation. The best part is just hedge, lock in your profits, right? And you can use any of these tools, which is currency futures or currency options. I talked about options. Many banks, like let's say Canara Bank or a Indian bank, they don't offer currency options because they don't run the option book, right? It's only a few large MNC banks, private sector banks, and select PSU banks who offer currency options. And again, the pricing is not, it's very opaque, which is there. So here one can come on the exchange OTC platform. Options are pretty liquid. Come use options and hedge their exposure. And most importantly, it's not that you need to hedge only a monthly exposure. Now exchange has got weekly currency futures and options. So even if in case you have something which is at a very short tenure, maybe a week, 2 weeks that you have exposure, you can come and hedge on the exchange platform. This is just on the contract specs. So I just wanted to highlight what is available to hedge is you have futures and you have all the 4 currency pairs, which is USD INR, Euro INR, GBP INR, and GPY INR. You can do a monthly contract or you can do a weekly contract. And all these are cash settle contract expiring at the end of the month for monthly contracts and on Fridays for the weekly contracts. You just need to make some margin, right, which you need to give, and then there'll be mark to market. Some of the corporates tell me, Ramesh, that is the biggest challenge. हमको margin देना पड़ता है. जहाँ कि हम जब बैंक जाते हैं, we have got our limits and there is no margin which is required. But other way of looking at it is, it's a great way of having a risk management, right? So one can look at placing margins and then hedge on the exchange platform. Similarly, there are currency options. Again, 4 currency pairs. There are monthly contracts. There are weekly contracts, and pretty liquid. If at all you compare in the capital market, non-Nifty, non-bank Nifty, any of the single stock, and you compare USD INR, I believe USD INR the most liquid single stock or any of the scripts which are traded on the exchange platform. Importance of risk management, I talked about it. like all these exporters, importers need to look at the profits that they make from the business and not make money from the exchange fluctuation. So one has to hedge their exposure, and volatility will always be there. Like today, we have seen almost 1.3, 1.4% of market of volatility in USD INR itself. You need to, and there can be many of the events like this, what has happened today, right? And it also helps in forecasting and managing your balance sheet. So how can one hedge? One can use a OTC platform, which is through banks. One can do a forward, and in case the bank is offering options, they can do that. Else not, they can come and do it on a exchange platform, which is futures and options. So this is all about currencies that I wanted to highlight. Again, summary is liquid platform, very transparent, ease of use is there, and you have a large trading hours, which is 9 o'clock to 5 o'clock, where you can come and hedge on the currencies platform. As I said, I'm going to cover currencies and commodities both. Moving ahead on commodities, again for SMEs, you all are into business of manufacturing. So you'll have some exposure. You might require a copper, aluminum, lead, nickel, zinc, any of these commodities for your manufacturing. And today itself, we have seen a volatility of almost 5% in nickel. There has been a 5 to 6% movement in aluminum. Just tell me, is it possible, because your input cost is going up now in manufacturing, the output, whatever you manufacture, the price volatility of input, whatever is required is 5%, right? Will you be able to go and negotiate the price at such a short notice? I think no. So the best part is all these commodities which are available, one should use the exchange platform, hedge the currency risk, and focus on their business only. It's a VUCA world, right? It's volatile, uncertain, complex, and there's a lot of ambiguity across the world. So one should hedge their commodity risk on the exchange platform. And let me tell you, last 6-7 years, there's been a lot of development which has happened on the commodities market. Earlier, it was FMC who was the regulator, but 2015 onwards, SEBI has taken over, and SEBI has done a fantastic job. Right, a lot of new things have happened after SEBI has come in. Mutual funds are allowed to participate now, which has helped in liquidity. Options have come, indices have come in commodities, which was not there before, and so many things have happened after SEBI has come in. So all the investors, traders, hedgers have lots of confidence on these commodity markets. Yeah, I agree. There's a little shallowness which is there, but I'm sure over a period of time, the liquidity and 5-month contracts will also become liquid. So this is what I wanted to talk, hedging versus trading. So all those entities, SMEs, MSMEs who have exposure should hedge their exposure. Advantages is there, you'll be able to manage your price risk, right? It will protect you from price volatility, which is there, and it will help you in managing your balance sheet. When it comes to trading, yeah, obviously in commodities market, unlike currencies where there are a lot of hedgers, commodities market, still there are a lot of traders who are there, and very little participation from the corporates, which is increasing now. There are a lot of traders who give the liquidity in this market and be the counterparty. All our commodities which are traded on MCX, take bullion, energy, or base metals, are all linked to international benchmark pricing. You have gold, which is traded in CME. You have LME, all these 5 base metals which is traded. And on Indian context, the lot size has been made small, right? If at all you look at aluminum, copper, it's 25 metric tons lot, which is traded globally. But when it comes to India, aluminum is 5 metric ton, copper is 2.5 metric tons. So what I mean to say is the lot size is small, which may help SMEs to hedge even the small exposure that they have. And the timings for these markets is from morning 9 o'clock to 11:30 or 11:55 late night. So you have ample time, and most of the volatility happens late in the evening. So you can hedge your exposure, whatever is there, late in the evening. Who are all the participants? Bank brokers like us, ICICI Securities, have been allowed now, which was not there before. SEBI came in. Mutual funds are there. Now EFEs, which is eligible foreign entities, are allowed to hedge the risk, whatever they have. There are alternate investment fund, CAT, who can participate in these markets. So vibrant market, right? Close to now, there were also days 60,000 crore is what was the volume, but average is close to 35 to 36,000 crores, which is traded on the exchange platform. Benefits of trading currencies and commodities at ICICI Direct. One, we are a bank broker, right? ICICI is a parent, strong management. We have a robust risk management process in place. We also have a power pack research. There's a team of 4 research professional personnel who are there and who keep advising our customers on what to do as per their exposure. Seamless transfer of funds, like you need not call up the broker and tell, you can just do transfer, everything is online. Competitive pricing, right? We at ISEC is just flat. We have made it very simple for currencies, commodities. It's just 20 rupees per order, irrespective of you buy 10 lots of aluminium or 1 lot of aluminium or 10 kgs of gold. Is just 20 rupees is what is the price of the brokerage. There's a dedicated support which is there. And it's not only commodity currency, there are a whole of products which my colleague Jolly briefed to you, that one can, it's the same platform where one can do currency, commodity and all other products. And we keep doing a lot of these kind of activities, what we are doing today to educate customers on commodities, currencies, and all of the products. So that's all the summary that I wanted to share today. We do come out with reports, and let me be very honest, last 1 year, our track record has been good. I'm not saying past performance will continue in the future also, but last 1 year, if at all you look at, our strike rate has been close to 70-71% on commodities. So that's all I wanted to share on commodities. Let me just see in case I can take you to the screen. Yeah. This is the NSE volumes that I was looking at. Yeah, this is the ICICI Direct platform, and all these reports are available in non-logged in section. So what I mean to say is, in case you're a customer, not customer, just go to commodities, click here, go to the products, then you have the research recommendation, you have daily research report, weekly report, monthly report, special reports, which are all available for you to download and read. So there's great quality reports which are being put up. My humble request is visit the site, navigate through it. Lot of information is there, lot of short videos are there, which may help you to take an informed decision. So that's all from my side. Sabharwal ji, over to you. Thank you. In case you are speaking, you're on mute, Sabharwal ji.
Thanks a lot, Mr. Ramesh. In a very short span of time, you told how currencies and commodities are beneficial for MSMEs and how they can hedge currencies as well as the commodities. And yes, you gave an excellent deliberation. We will call you a speaker in one of the next programs also, because of today, the various reasons the attendance is short. So in one of our next programs, we'll be calling you. And now the most sought after person, one of the most sought after person of the country, who normally whole of the day is available on the TV channels, and a real economist. He actually, to the PhD people, he doesn't require any introduction. And as we may be having short of time, I straight away hand over to Mr. Ajay Bagga to speak about the Indian economy, the world economy, how Indian markets are related with the world, for which he is an expert. And after that, in the chat box, we have 2-3 questions for him, which we'll take on later. Over to you, Mr. Ajay Bagga.
Thank you, sir. Thank you. Thank you, Mr. Sabharwal, Wadhwaji. Thank you for inviting me again. Vivekji, thank you. Just one point, the electricity is fluctuating. I'm in a rural area right now, and at times I'm getting disconnected, but it's coming back in a few seconds. So please bear with me in case the connection fluctuates. I have a UPS, but somehow the Wi-Fi takes a few seconds to catch, and in that time I might get disconnected. So bear with me.
Please
so we'll
continue,
start off. Yes, sir. So we started off this year on a note of a little caution after 2 great years of recovery after the COVID. There was caution that growth will slow down, and the big reason being that the liquidity from the central banks and the fiscal stimulus, both of these will be slowly withdrawn, will be reduced. Most of the central banks were in a tapering position, if not in an outright rate hike, tightening kind of a position. So that was happening, that was expected. That was the biggest risk that we were seeing. Second big risk we were seeing was on inflation, which has been persistent for some time. And the US Fed finally gave up in November when it said it's not transient. It will take some time to work out. Third was where India was directly impacted was the commodity prices, and especially for oil, where we are a big importer. We are amongst the third biggest consumer of oil in the world, and 84% of our usage we import. So we are very much dependent on global oil prices. And just to give you an idea, a 10% increase in prices of oil means a 0.5% hike in our consumer inflation, a 1% hike in our wholesale inflation. So that is the kind of correlation of India with the global oil prices. Government is working on renewables, but that is a 15-20 year task, because right now about 96% of our energy is still from fossil fuels, coal, oil, or gas. So it will take time. It's not going to happen overnight. In fact, the target of carbon neutrality for Indian government is also a stretch target. So this was the third, commodity prices feeding into the inflation.
सर आप muted है.
Yeah. Sorry for that. That's the electricity. The fourth big issue that we were foreseeing, that markets had done very well over the last 2 years, especially the Indian market had outperformed, and the valuations were stretched from September itself. Foreign investors had taken out reports saying that Indian market is tending towards overvaluation. We were saying that we have the growth, so this overvaluation is factored in by the higher growth that we have. But there was a thing that these markets are not cheap. And fifth was flows itself. In anticipation of the Fed tightening rates down this year, the US dollar had been appreciating. And we have seen a negative correlation of US dollar and emerging market flows. So whenever the dollar strengthens, we see that emerging markets see outflows. And that had started for us from September, and large amounts like 30,000-40,000 crores a month have gone out over the last 5 months from our markets. So we were facing this outflow from the secondary markets. The sixth thing was that IPOs had been very successful last year, and there was a big IPO of LIC also scheduled by the government anytime within the first quarter. So we were expecting that some money might go out from the secondary markets to fund this IPO, both on the institutional side as well as on the retail client side. So these were the big issues. There was geopolitical risk, but geopolitical risk we see every year. So we tend to discount it. We say that markets have factored it in. Let's just move on. Ukraine was not one of the bigger risks. Actually, it was more on China. It was more on Iran nuclear deal. It was more between Saudi and the Yemenis. These were the bigger flashpoints that most of the 2022 outlooks pointed. Ukraine was a small part, but no one thought that such a misadventure on this scale would take place in the heart of Europe. Now, where are we with respect to these risks? There was a correction in January in global markets when the Fed minutes of December meeting came out, where it was said that they would start normalization of balance sheet. So we had seen the Fed in the US tightening across a three-step process. First, they would complete the taper. That is, they would stop buying monthly bonds. They were buying 120 billion. They started slowing it by 15 billion a month in November. Then in December, they said we will slow by 30 billion. And we were expecting by March, this will be completed. After that, they will see, and maybe they will hike rates 1 or 2 times. In December, it came out that they are going to hike 3 times in 2022. But by January, when they said we would also like to contract our balance sheet, which has gone from $4 trillion to $9 trillion in 2 years. Basically, they have been monetizing all their deficits by printing money and giving out liquidity in the markets. So if they start taking out that liquidity, that would have hurt markets. And January, we saw a correction on that. So the bigger issue for us was a misstep or a miscalculation by the central bankers, where they tightened too fast, and the markets which were used to huge liquidity, they contracted too fast. That was our biggest risk that we were seeing. But what has happened over the last 2 weeks with this ratcheting up of the discourse on Ukraine, all of a sudden, we came from an issue of Fed interest rate hike threatening the markets to Ukraine. Now, in a overall sense, Russian market is 1.5% globally. Russian GDP is not that great. It's about $2 trillion plus. Most of it is commodity exports and agricultural exports, some defense exports. So we were not really seeing that big an impact. And if you look at 2008, when Russia invaded Georgia, markets hardly moved 1.5% down for about 3 days, and then it recovered. 2014, when Russia took over Crimea, again, the markets went down about 2%, 2.5% across the world, more in Europe. And within about a week's time, the markets were back to the same level and going ahead. So we expected that this time also, there will be a small plunge in the markets, and then they will recover very fast. But so far, we have been proved wrong. Secondly, we thought that, in a civilized world, in the heart of Europe, this is not some underdeveloped continent or emerging market or a fourth world country. It's the heart of Europe. There will be a dialogue, and everyone will not want to see deaths happening. But we forgot that between 2014 and now, in the disputed areas of Ukraine, over 14,000 people have got killed, which is including nearly 10,000 soldiers on both sides, Russian and Ukrainian, and about 4,000 civilians. So we were hoping for the best, that Putin will see reason and the West will be able to, through diplomacy and inducements, make sure that there was a amenable discourse. We were hoping that Ukraine itself will say, okay, we don't want to be part of NATO. We will be like Finland. Finland, throughout the Cold War, right after World War II onwards, they stayed neutral. So they were not a satellite of Russia, but they were not part of NATO either. And Russia was happy for that because they had a buffer of Finland. Sweden never joined NATO. Again, it was a country behind Finland, but they paid the respect, and they did not join NATO. They stayed equidistant. Both are very westernized, highly developed countries. So they were Western in their outlook, in their economy, but they took care of Russian sensitivities. With Ukraine now, it's a different Putin. Even from 2014, it's different. And he is using strategic ambiguity. He's creating a lot of uncertainty. He says one thing and does the total other way. So it's like another Hitler has been reborn. on the European continent. And that is what is scaring markets, that how big will this become? How broad will this become? US, if you notice, in December itself, they said, we will not commit our troops on the ground to defend Ukraine. We will not give it heavy weapons. We'll give it light weapons. In fact, smaller countries in Europe gave more aid to Ukraine than US, but entire NATO, UK and US all said they will not come to the aid of Ukraine. And they thought that this will give a lot of reassurance to Putin and he will not act, but he has acted. And this morning he has done a full-fledged invasion from multiple locations. So first he surrounded Ukraine for a number of months. And now today the invasion is launched. Again, he's saying something, but we have stopped looking at his statements because you can't trust him at all. What do we do now? Impact on India is very little. Our trade with Ukraine is hardly about $2.5 billion. Most of it is sunflower oil, some fertilizer, some other agri-commodities that we take from them. We export out some pharma, some chemicals again to them. 20,000 of our children are studying there because the medical schools were very good and very cheap in the erstwhile USSR, and that has carried on in Ukraine. Getting those children safely back is now a priority of the government. Some have come back. I hope all will come back. So on an economic scale, it has very little impact for us. So why did our markets fall 5% today? It was a function of all these factors, which I listed already: inflation, central banks tightening, overvalued market, flows already were negative. Plus what came in today was global markets and global uncertainty went up a lot on how broad will this sell-off, how broad will this conflict be, how long-lasting. If you look at the US markets, the US futures are down 1.5%. So we are so far away from Europe. We are not even an active participant on either side. And neither the rest of Asia was down 1.5%, 2%. Russia was down 50%. That you can understand. Again, it's a very small market. It doesn't matter. And it's mostly the Russian companies will get sanctioned. So people started pulling out their money. A lot of them are listed on the London Stock Exchange also. So I'm sure the investors started pulling out that money in a rush. Big reason for us was it's a continuity of foreigners taking out. But what we have seen is our domestic institutions were buyers every day. Today, we think the participation was lesser from domestic institutions. We'll see the numbers in another couple of hours from the exchanges. The third is China. If you look at any sanctions, who's the biggest beneficiary, right from all the sanctions US has put, whether on Venezuela, whether on Iran, whether on Korea, whether on Russia, it is China. China steps in, it breaks all the rules in the world, and it engages with that pariah state and makes sure that they get a benefit. So sitting on our borders, supplying fourth generation aeroplanes to Pakistan, supplying the latest submarines to Pakistan, supplying frigates to Pakistan, they have been the bigger issue for us, and they will be the biggest beneficiary as Russia tilts eastwards and this wall between Russia and the Western countries becomes solidified. That is one reason. Second is, of course, being importers of oil. This is going to hurt us. Oil went up to 2014 levels. It crossed $100, and it will probably go to $120, $125 unless Saudis step in and start producing more. Only two people with spare capacity right now are Saudis and Iraq. US releasing reserves and all is not very meaningful because that capacity will hardly last for 2-3 days. And then what do we do? So Saudis can do 3 million barrels more a day. Can they step in? Russia is still supplying gas. Nord Stream 1 is still working. Nord Stream 2, which was not functional yet, has been put on the back burner. But Russia is still producing that 9 to 10 million barrels a day. So it's not that the Russian supply has gone out. The risk is if you're not able to engage with Russia because its banks are kicked out of SWIFT, because sanctions are put, then what happens? There is nobody else. You look at how much Russia produces. Aluminium, for example, 5.6% of the world is Russia, but nearly 70% of European aluminium comes from Russia. Gas and oil, it is a 10% producer. World doesn't have that much capacity to bring in. And the Chinese are ready to buy, like they are buying from Iran. Some neutral ship will pick it up. And then on the high seas, the Chinese switch off the GPS systems, transfer the oil into Chinese tankers, and then it comes to Chinese ports with a different bill. And you can't trace it that it's Iranian oil. So China has set up a pipeline with Russia so that gas and oil will be absorbed by China to a large extent. So hopefully the normal suppliers of China will supply to the rest of the world and will not see a supply destruction, but the risk is there. Palladium, Russia makes 46% of the world. You see, palladium went to 2400. Nickel, it's a very big producer. Wheat, soybean, and corn, it's a huge producer. And Ukraine is also a very big producer. Between the two of them, they are 29% of global wheat exports. So you saw Egypt getting very worried because it's a big beneficiary of Ukraine and Russian wheat. And if that gets stopped, what happens? And the impact on the European markets, it's next door to them. It is more the US nuclear deterrent, which is really stopping, because since 49, when NATO came up, there has been underinvestment by the Europeans in their land armies. So if you look at the Russian army, it's down from 4 million to about 1.5 million. Another 2 million in reserves, you can say. France and Germany, the biggest land armies, are 150,000 people each. So combat troops, you can say easily half of that. UK has a standing army of 150,000. And all the other smaller countries have 20,000 to 5,000. Estonia, Latvia, Lithuania have 7,000 army. That can do nothing against the Russian land army. So the US nuclear deterrent used to work. But for a madman and an autocrat, if he wants to come in, then that deterrence is too big a risk. Better that you don't deter. That is what the markets are factoring in. If this conflict erupts into a broader conflict, very low probability still, but we have been consistently wrong. All the pundits who were saying that Putin will just do saber rattling, and even when he took over those two provinces, they said now he's met his objectives. But today he's changed the game again. He's saying, I want to demilitarize Ukraine. You can't believe anything he says. So he wants to make Ukraine a satellite. And after that, what? Will he stop there? Or will he go and reclaim all the Soviet Empire countries, which are now free countries and part of NATO? What will happen to Czechoslovakia, Bulgaria, Romania, Moldova, entire old Yugoslavia, and then the Baltic states at the top? Where will he stop? What will it do? We'll have to see. Today, US sanctions will come, which they have been agonizing over. Sanctions have so far not worked. They will not work again. Today, Trump is leading a very good economy. He has $640 billion of FX reserves. He has put $250 billion into a national fund, which he has created for a day like this. He's not bothered about the stock market because that money is largely of the Western investors. The UK listing of his companies itself is $460 billion yesterday. Today, it has gone to $230 billion. and that is all Western investors. So it doesn't matter to him. Nearly 1/3 of his market is offshore. He has a very low debt to GDP of nearly 30%, much better economy that way than most of the Western economies, which are 150 to 300% debt to GDP. And every time oil goes up, other commodities goes up, and he's able to sell to the Chinese. He's in a good position. So second order effects is the thing. Third order effects, people like North Korea, people like China are watching that if the US is so weak because of their mistakes in Afghanistan, because of their mistake in invading Iraq, US is so weak, will they come to save South Korea? Will they come to save Taiwan? Today, North Korea has a huge advantage on South Korea. What saves South Korea is the US having 20,000 troops there and the nuclear deterrent. Taiwan doesn't have US troops, and there is no return guarantee by the US. US had given a guarantee in '94 to Ukraine when they took away all the nuclear armaments of Ukraine. Ukraine at that time was the third biggest nuclear power in the world. The US was very concerned that these nuclear weapons should not go in the wrong hands. So they did an agreement. 1994, US, UK, and Russia have given a guarantee of safeguarding Ukraine. And Ukraine at that time gave up its nuclear armaments to Russia. And today, nobody has come to its defense, and one of those three signatories has actually invaded it. So North Korea is not going to give up its nuclear arsenal. And if you see its standing army, it's multiple times of South Korea. It can overrun it in a matter of days if it wants to. And if US doesn't stand by, then it's a difficult situation. So these third order effects is what is causing Taiwan. You can say insignificant, but significant in the semiconductor supply chain. So 25% of global semiconductor production goes off if Taiwan is captured by China. All your automobile production, electronics production, from aircraft to electronics, everything will get hugely impacted. And very cutting edge technology comes into the Chinese hands. So those are the strategic issues that we are facing. Markets have factored in a lot. So I will conclude by some crystal ball gazing. Is it falling more? I think so. I think this conflict will get broader before it peters out. It's not going to end that soon. So tomorrow, I'm not expecting that you will have a bounce back and things will be good. It could run off for a couple of weeks at least before you start getting anything. Total trust is gone. Trust in international rule of law is gone. And you have 19th century characters like Xi Jinping and Putin running very significant armies in the world who don't abide by any global rule of law. It really heightens our risk. So not a buy on dips market. Technically, very significant levels have gone broken. And, mostly at this time, you will see one pullback coming, and that's a false one. And then again, it falls down. So I have been telling whoever is calling me that wait and watch, stay on the sidelines. Is it a time to sell off? No, never sell into fear, never sell into panic. Just hold. If your asset allocation is good and that's the amount you should be in equities, just stick to it. I'm not asking to add more. That time will come. Let's get some clues first, how bad this goes and for how long, then it might be a better idea. In inflationary times, what are the sectors that do better? Finance, energy, materials, commodities, real estate, REITs, InvITs, capital goods, industrials, all these will do better because inflation is there along with a strong economy, a recovering economy. These are the sectors that will normally outperform. How long will this conflict last? Only Putin and his 5 advisors know. All the West, everybody wants it to shut down soon. Nobody is really bothered if he takes over Ukraine. There's a huge human cost. Nearly about 50 soldiers have already died today, as per reports. Many more will die, unfortunately. Human costs are very huge. Even in 2014, when it happened, nearly 1.5 million Ukrainians are today refugees across the world. 66,000 Ukrainian doctors have left, gone into Poland, gone into Hungary, practicing there. They have left their mother country. So there will be a huge exodus of Ukrainian refugees. The Russians have a kill list of who all they want to kill. They will wipe out the elites like what Germany did to Poland and to Finland. It's very clear they want to put their own puppets in all the business and ruling class, and they made the list. All the journalists, those are on the kill list as per Western reports. So there will be a bloodbath either ways, and that will keep markets jittery. The silver lining, the central banks will hold their hand. So what people were talking that March 16th Fed might raise rates by 50 basis points, 100 basis points, that will probably come down to 25 basis points, if at all, or they will say we'll wait and watch. Now is not the time. I would agree with that because even though inflation will go up, that's because of this disruption of supplies of Russia. That's not the time to really tighten, because tightening will only kill your industry, kill consumer sentiment. It will not lead to breaking the back of inflation. Inflation is a cost push inflation. It is not because of huge demand that's coming in. It's rather because demand is stable, but supply has got constrained by 10%. So any sensible central banker, I would expect that they would remove any chance of a rate hike for now and say, we'll wait and watch, let this resolve. So that in a nutshell, India not very impacted. Our fundamentals are same, our economy is the same, our growth will be pretty similar. We have an inflation issue with this oil. I think best situation would be the government has to absorb at least some part of this. So they should set aside some money and keep the economy, economy insulated from this oil hike. Already from nearly 90 days now, the oil hike has not happened after the excise duty cuts, because the elections got announced pretty soon after. So we were expecting March 7th, 10th, nearly a 10 rupee hike in the petrol and diesel costs. Now at these new rates, you need a 20 rupee hike probably. I don't know. I hope the government sets aside 1 lakh crores or something. And like France has put aside 15 billion euros just to ensure consumers are not impacted by these gas price hikes and the petrol hikes. We'll have to do something to subsidize the economy. If we pass it all on, we are looking at a very deep recession coming by. So that's the risk. That's what the markets are pointing out. Markets are 6 months ahead of all our thinking. So they are thinking the worst in geopolitical terms, that the entire Russian production goes out of the market. It will not. Mario Draghi, former ECB chairperson, and now the president of Italy, has said very clearly, keep energy out of the sanctions. So within Europe also, they are divided. He doesn't want to sanction Russian energy. He's saying you do the other things. Very big banks are sitting in Russia, Western banks today. The ECB and the BIS has asked them to give, take a stock of that. Big companies, including our own ONGC and BPCL, are invested in the Russian oil and gas. They will have a big problem there. So there are many linkages. It's a very interconnected world, and you can't just take it out straight away. Like in 2018, when Trump put sanctions on Rusal, the Russian aluminum company, the aluminum prices shot up so fast that he had to very soon, after a matter of days, he had to reverse his decision. Excuse me. So it's not easy. and sanctions don't really work. They benefit China always, and markets are fearing the worst. That's what, stay invested. It's going to be a roller coaster ride, and it's a tough few weeks for us. Conserve your remaining capital, but don't sell in this panic. I think it's going to form a bottom ultimately. In hopefully a couple of weeks, 3 weeks, we get the bottom formation. But who knows? So better to hang on to your cash for now. Yes,
Thanks a
Mr.
lot, Mr. Bagga. It was really wonderful that ex tempo you talked of everything. The European politics, the world politics, the world economy, about the Indian economy, what should we do, what should we not do, that your advice that we should not sell in the panic, but to buy, we should wait for the bottom also. Sir, I will like to inform you that we have recorded this event, and I personally will be ensuring that it will go to most of our members, the total event, those who could not attend. I also welcome actually our PhD Capital Market and Commodity Market Committee, Executive Committee members, Dr. Arya from Visakhapatnam, Dr. Arya, a golfer from Visakhapatnam, Rotarian Sunil Bansal from Lucknow. So, Bagga Sahab, this is the same Sunil Bansal who last year in one of the event in which you spoke to Rotarians on Varanasi and Lucknow, more than 500 plus attendance was there. Yes. We also welcome the Executive Committee member of PhD Capital Market and Commodity Market Committee, Mr. Anuj Gupta. We have Mr. Ajay Saxena from Jaipur with us, and other senior members, Mr. Anil Kishore, Mr. Vikram Rathi are also with us. Sir, there is a question from Mr. Ajay Saxena. It is in the chat box, though partly you have replied. And the question is, sir, how you see the FII regularly selling from last few months about the Indian market? How you see on that account to the Indian markets? The FII regularly selling from last few months.
Yeah. So that's a fact. FIIs on a composite basis have been selling, but on the primary market, we got nearly most of it back in terms of IPOs coming back. Second, if you look at the private equity flows into startups, that was another $39 billion. So on a consolidated basis, foreign investors have put money into the country over the year. But in the secondary markets, we have lost huge amounts. Reasons being clearly, one around September, when a lot of the foreign brokerages took out reports on India being overvalued, and investors started saying that let's go underweight on India. Second, the impact of commodities and especially oil going up 55% last year, 25% this year on our economy. So that was a factor. And third, the Fed move from accommodative to tightening, and tightening very rapidly. That leads to a stronger dollar, and stronger dollar sees EM outflows. And within EMs, which is the country which with minimum impact cost allows FIs a smooth exit, it's India. We get more of the share when they go out because we are able to absorb it. And if you see the selling, it has been in banks, it has been in our top-notch blue chips. So it's not because of fundamentals or India, people losing faith in India. It's more on their liquidity, more on their macro reallocation of global liquidity that is happening, or some sell-off in the emerging market basket. So being parts of those ETFs, we have also seen our fair share of outflows. How long will this last? We were thinking most of it is done now. Already FI holdings are at a low. And especially with the kind of corrections the markets are seeing and the growth outlook, that's a very potent combination. So as the geopolitical risk goes off and we understand more of the thinking of the Fed, I had personally thought the dollar would peak by April, May, because everybody was, there was a long only dollar trade playing in the world, and normally it reverses then if everybody is one way. Now, with geopolitical risks, safe havens will see money. See the US 10-year, it's gone down to 1.85, and all irrespective of what's the inflation or the Fed outlook. So crazy things are happening in all the markets. And in this market, it's very tough to say. But I would say we are becoming a compelling inflow point again. But global flows have to turn back to emerging markets. Only then we'll see that. And a lot of that, one is the geopolitics has to go out. Second is what is the Fed outlook? Like just on 19th Feb, JP Morgan had said 9 rate hikes in 2022. A week before that, Goldman Sachs said 7 rate hikes. So markets were really crazy, and the Fed Watch tool that is used was showing 1.75% by the end of this year. Even though the final rate in 2024 is the same, there nothing has changed. But what had to happen in 2 years, they wanted to do in 6 months, and markets were getting jittery. Now with this thing, let's see what comes out on 16th March, and that will set the tone. But I would say another 2-3 months, the FI flows should reverse. They are going to be looking for areas of growth, and India is very much there, very high on governance, very high on property protection, very clear tax laws and ability. They have tested it lot of times, bringing it in and taking out the funds very smoothly. So I think it will reverse. Hopefully in the next 2-3 months, I'm expecting a reversal.
Thanks
Yes,
a lot, sir. And now I request the PhD Capital Market and County Market Committee's Executive Committee member, golfer Dr. Satish Arya from Visakhapatnam, to formally give vote of thanks. Actually, our co-chairman has just left. He had some physical problem. So I request Dr. Satish Arya ji from Visakhapatnam to give a formal vote of thanks. Over to you, Dr. Arya.
Thank you, Sabarwal ji. Thanks a lot. Sir, on behalf of the CPI, I thanks especially Ajay Bagga ji for sparing such a valuable time and his vast experience. Sir, you are the real market guru actually. Economist guru, market guru, whatever word, there's no words actually. And especially today, it is such a need of such advice, which already Sabarwal ji said that which will be circulated to everywhere. So this is a fantastic advice has been given today. This is real patience-full advice. And I thank Ramesh ji and Inderbir Singh Jolly ji for their valuable introduction to this, giving the entire detail of the currency and derivatives completely, and the entire ICICI team, those who are logged in. And I thank Narendra Vadva ji, our president, and our mentor Ashok ji, all for their real guidance and contribution, and not the least, all members and all participants, and Shivani and his team. Entire thanks to all of you. Thank you very much, sir.
Thank you.
Thanks a lot.
Thank you so
Thanks a lot.
much, sir.
Sunil Bansal ji, will you like to say a few words? Sunil Bansal ji, कुछ आप 2 शब्द कहेंगे? अजय बग्गा जी पिछले साल आपके प्रोग्राम में आए थे जहां आपने 500 रोटेरियन इकट्ठे किए हुए थे.
थैंक यू सबरवाल जी. अजय बग्गा जी के तो बहुत फैन इकट्ठा हैं, उसमें एक मैं भी हूँ. और अजय बग्गा जी इंटरनेशनल बातें करते हैं. आज इंटरनेशनल बात की ज्यादा आवश्यकता है कि इंटरनेशनली इम्पैक्ट का ये असर हमारे शेयर मार्केट में क्या पड़ेगा. और इनकी इस बात से बड़ा आश्वासन मिला कि हम इंडिया में ज्यादा मार्केट गिर गई है, मार्केट रिकवर कर गई है. ये हम ऐसे इन्वेस्टर, ब्रोकर और हमारे साथ जुड़े इन्वेस्टर के लिए बहुत फायदेमंद बात है. आपकी राय. आपको बहुत बहुत साधुवाद. धन्यवाद.
Thank you, Sunil.
थैंक यू. अजय सक्सेना जी, आपको अपने प्रश्न का जवाब मिल गया होगा और बहुत ही अच्छे से he has replied to your question. Ajay Saxena ji, will you like to add anything? Ajay Saxena ji from Jaipur.
Sir, I think he cannot speak because he is not part of the panelist.
Chaliye. Thanks a lot, Shivani, that for managing it so well. And you discuss with me tomorrow. We will circulate it to all the PhD members. The speaker,
Sure,
Mr.
sir.
Bagga.
Thank you, sir. Thank you.
Thanks to all participants. Thanks again, Rajesh ji. Thanks a lot. Thanks again.
Thank you so much, everyone.
Thanks, Ramesh. Thanks.
Thank you. Thank you.
Thank you.
Pleasure.